Coming up in today's show, stocks finished the day higher on the back of a bunch of economic data, the huge ARM IPO, some commentary from billionaire investors, the market's reaction to Adobe's earnings, and Mexico discovers aliens. Hey, what's up everybody? Welcome back to your favorite finance channel on YouTube, the Click Capital Daily Market Show. My name's Jared. I'm going to get you up to scratch on everything important happening out there in the markets today and discuss the potential opportunities and risks out there. And it was a pretty bullish day here on this Thursday in Wall Street. Most sectors finishing in the green with a lot of bullish breadth across the board, even in the defensive sectors like utilities. REITs had a good day, industrials perked up, financials still bouncing back a little bit, and mega cap tech holding up pretty good as well. And just before we get stuck into the daily show, I just want to say a quick big thank you to everybody who's taken advantage of my special offer this week and purchased all my custom indicators for TradingView that I've developed over the last couple of years. I've been blown away by the response to this, and it's great to hear all your feedback and how much everyone's enjoying the new dark pool percentage indicator. And I know a lot of you are excited to incorporate that in your trading going forward. So again, thank you for that, for not only having faith in my indicators and ability to bring you more going forward, but also for supporting the Click Capital channel. As I know there's a lot of choices out there in the finance niche on YouTube, and many others out there will try and sell you a $2,000 course or beg for your donations or sell you some service with murky performance and no real track record. However, with me, you won't ever get any of that. Instead, I choose to share with you my own personal indicators that I use myself every day to manage my portfolios for my family and clients, including my Only Bears portfolio on the Collective 2 marketplace, which is up 29% since December. And I manage this portfolio personally myself for clients exclusively using my indicators that you can still get for more than 50% off for the next 3 days only. I normally sell them all for $497. However, just for a couple more days, you can get them all for the one-time fee of $237. And that'll also give you access to all future indicators I make free of charge. And I promise you, I won't ever sell them for this cheap again. This will be the last time I sell them all for $237 just for the next 3 days only. So if you haven't already, click the link below the video in the description and check this offer out. You can learn about all my indicators and watch the video on this page as well, where I go into detail about them all and how to best use them. So once again, thanks everybody who has already joined. I truly appreciate your business, and I look forward to delivering even more cool stuff in the future to you. Okay, moving on with the daily market show. We got a bunch of economic data out today. Retail sales, producer prices, and jobless claims that the market has been digesting and reacting to. The first one was the European Central Bank, and they increased their rates to 4.5%, which is the highest they've ever had their interest rate since the European Union came together in 1999. And that was above consensus too. The market didn't think we were going to get that rate hike, and I'll get into that a bit later. But just coming out of the States, where those producer price index coming in a bit hotter than expected. Month over month, we got 0.7 growth versus 0.4. And that's just another sign that inflation is sticky. Over to retail sales, and it was a little bit more mixed out there. Year over year growth came in a little softer than expected at 2.5%, but month over month came in a little hotter than expected, 0.6 versus 0.4. And then weekly jobless claims just came in a touch slower than expected at 220,000, showing that the labour market is still holding up for now. And just looking at the bond market's reaction to that data, was a pretty muted response. We've still got the 2-year government bond yield just sitting just above 5%, and December Fed Fund futures just pulling back a bit here. And we can see that in the Fed Fund futures implied probabilities actually jumping a bit today that the Fed will pause in November, and the market's still giving a slightly better than half chance that the Fed is done. However, there still is at least a 1 in 3 chance that we may get another hike. So the market and the Fed for now is leaving the door open on possibly another hike. However, I think the Fed would much prefer that they're done, stay on pause for a few months and see how the most aggressive rate hiking cycle in history plays out through the economy and what sort of damage it will eventually cause. And the bond market still thinks we're going to get a recession next year, and that's why they're pricing that the Fed will start cutting rates come May. Also helping get the stock market excited today was the biggest IPO we've seen in quite some time, and it did pretty well on its first day of trading. And that is British chip maker ARM, which finished the first day of trading 25% above the IPO price, and now already with a market cap of 68 billion, and this is already trading on a really rich valuation, because for the fiscal year ending in March, they did 2.67 billion in revenue. So that's already a price to sales over 20, which is pretty rich. And this has been one of the more successful investments for famous Japanese investor Masashi Son and his SoftBank company, which has a pretty large position in ARM and still retains a good stake in it. And there's a look at the chart of ARM today, with the first candle printing on huge volume, 129 million shares traded. We're trading a little bit higher in post-market as I speak. And some people are wondering whether this is going to help spark a fire underneath the IPO sector again, because it has been pretty quiet for fresh equity for over a year now, with the number of deals and the value of those deals coming onto the market falling dramatically since the first quarter in 21, when we're at the peak of the everything bubble. And we can see that in the weekly price action of the IPO ETF after it ripped higher really hard after COVID, going from $20 a unit all the way to $77 a unit, and came off really hard last year, as a lot of the other sensitive sectors in the market did as well. However, it looks to have possibly found a bottom and has actually been trading really well so far this year. However, just looking at the daily chart today, we're still trading below the 50-day VWAP, and overall, the IPO market isn't getting too excited just yet on the back of that. However, some are saying we're not going to see those 2021 highs for quite some time, with Fidelity's global macro head saying the stock market bull run is in its twilight. He points to the fact that now 2-year treasuries are paying a yield of almost 5%, the highest level since 2006, and that the yield difference between bonds and equities is at its worst for equities in quite some time. He's saying that suggests the secular bull market for equities is in its twilight. He went on to say it seems safe to assume that we will go from double digits to single digits in the years ahead, with valuations bearing the brunt of the reset. Another factor in the markets that could upset the soft landing scenario is that of crude oil, which got above $90 a barrel today and is looking more and more by the day to be in a technical uptrend, and that's going to help keep upside pressure on inflation and make the Fed's job a lot more harder, and that's thanks to Saudi Arabia and Russia that have committed to production cuts through to the end of the year and could very well extend them going into next year. And that's at a time when the US Strategic Petroleum Reserve sits at 40-year lows. And also coming more and more into the political and public spotlight is that of the long-term debt held by the US federal government, with former Treasury Secretary Larry Summers saying the Fed needs to pay more attention to that. He's saying at the current pace it's becoming increasingly unsustainable, and that Jay Powell and the Fed as a whole need to factor that into their decisions going forward. And we've also got others like billionaire investor Ray Dalio pretty much saying the same thing in regards to US debt, and he thinks bonds aren't a good long-term investment because he said if investors aren't receiving a high enough real interest rate, they will sell bonds. And for those of you who don't know, real interest rate is the interest rate minus inflation. So for example, if the current interest rate were 5% and then the current inflation rate were 4%, then the real interest rate would be 1%. And that's the point Ray Dalio is making, that high inflation damages the real returns from bonds. And that's why he's saying cash is a good investment right now. And he said the supply-demand imbalance isn't just the amount of new bonds, it's the issue of do you choose to sell the bonds. He said if the selling happens, it forces interest rates to go up further as the market needs to attract bond buyers. He said when the interest rates go up, the central bank then has to make a choice. Do they let them go up and have the consequences of that, or do they then print money and buy those bonds? And that has inflationary consequences. And he does make a good point, because in the last quarter alone, the Treasury sold over $1 trillion in T-bills, and then we've got a further $7.6 trillion in US debt coming due in under a year, along with a lot of corporate debt that'll need refinancing as well. So that should help keep upside pressure on interest rates, because there's so much debt that needs to be sold, competing for the same amount of bond investor capital. They're going to have to offer higher rates to compete for that capital. That's why we've got others like former PIMCO bond king Bill Gross saying investors are ignoring a big threat to stocks and putting too much faith in the Fed. He's skeptical the Fed will achieve 2% inflation and cut interest rates anytime soon. He said the US economy relies on asset prices rising, putting it at risk if they don't. And once again, he pointed to the yield differential between bonds and stocks. He also said the US economy's had a surprising resilience to the Fed's rate hikes thus far, and that's likely been helped by the historic amount of government spending during the pandemic. And he said now the last of it is just being spent. And some others are saying the biggest and arguably the most important stock in the market, Apple, already has a sky-high valuation. And this is unreasonable considering that sales have been going backwards, with this analyst saying that the company's actually shrinking. And so he could potentially be right, and there could be some credibility to the statement that Apple could be overvalued here, because we can see it trades at just under a 30 multiple, and that's price to earnings. So at $175 a share, that's approximately 30 times as much earnings they make per share. And how you work out the earnings yield is you start with 100 and then divide that by the PE. In Apple's case is 30, and that gives us 3.33. So currently Apple has an earnings yield of 3.33%, which is okay if the company is significantly growing their earnings. For example, if they were growing at 10-15%, then that earnings yield next year on your capital invested would be somewhere around 3.6-3.7%. Then of course in stock investing, you can't look at valuations in a vacuum. It's all relative to what you can get pretty much risk-free from the US government. And like we can see on this chart, 1-year government bonds are yielding 5.42%, and it's easy to find a yield north of 5% in money market funds with the full safety and liquidity that US government bonds offer. So investors have got to ask themselves, is it worth receiving over 200 basis points lower from the US government and getting 3.3% yield on your money in Apple shares. So I guess the question comes down to, will their new iPhone cycle, the 15, help get them back to growth again and get their earnings per share increasing? And that's something the market will be really looking forward to in 42 days when they report earnings on the 26th of October. The market will be looking to see a big bump up in orders and people upgrading to the latest iPhone for signs that Apple is getting back to growth, because the last couple of quarters, their earnings per share were actually lower than the previous years. And just looking at the price action today, we can see Apple's stock is trying to find support around this 174 level, and this will be key for its stock and the market as a whole as well. Also out today, just after close, is earnings from Adobe, another important tech stock, and they're still growing pretty good. They just reported third quarter net income of $305 a share compared with $242 a share from a year ago, and revenue rose as well to $4.89 billion from $4.43 billion, and that was a slight beat on analyst estimates. And just looking at a 5-minute chart of how Adobe's trading in the after hours as I speak, we're down a little over 1.9%, so the market's having a pretty soft reaction to this report. And that was a similar story after we got Oracle's earnings on Monday afternoon. Even though they slightly beat, the market sold them off 13.5%. However, we have had a little bit of a bounce the last 2 days. And so out of the 4 major economic centers in the world, North America, Europe, China, Japan, the US really is the standout currently and holding up the best. However, Europe looks to be going further into a stagflation scenario, and that's stagnating economic growth along with persistently high inflation, which is typically not a good scenario for growth assets. And especially with the rising price of oil, Europe is very dependent on others for their energy supplies, with their leaders over the last 10-15 years heavily relying on countries like Russia for their energy, only to be exposed over the last 2 years how vulnerable and leveraged they were to them. And it looks like they have really recognized that and are on a path to self-reliance to energy, but that's still a long way away. And so for now, inflation is still persistent in the Eurozone. And that's why we've got the president of the European Central Bank, ECB, Christine Lagarde, jacking the central bank's main deposit facility rate to a record 4%. And that still sounds low to a lot of us that have seen rates as high as 7-8% in our lifetimes, but that's the highest level the European Central Union has had their rates since they first formed in 1999, and that's on the back of their increased projections for inflation, which they now see averaging 5.6% this year from their prior forecast of 5.4%. And on top of this, they also lowered their economic growth projections from 0.9% to 0.7%. So based on that, there's over 4 full percentage points difference between inflation rate and the economic growth rate, and thus a stagflation scenario. And a bit of interesting news for you here today, and that's the Mexican Congress holding a hearing on UFOs featuring 2 purported alien bodies. We've been hearing a lot about aliens coming out lately, with talk from NASA and other insiders and former workers that the governments hold foreign objects and materials. And so this is really interesting to see if this is real or not, who knows. But the talk about aliens and UFOs just seems to be getting deeper and deeper. And who knows, maybe we will be getting a visit from them sometime soon. There's the Fear and Greed Index climbing a little bit today, but still in the neutral zone. There's a look at corporate insider activity, increasing a bit yesterday, both on selling and buying. But overall, insiders are still not doing a lot of buying here. Okay, back into the charts, and it was pretty bullish across the board today. All US indices finishing higher, and that was led by micro caps and small caps as well, showing that there was a bit of good breadth across the market. It was actually the Nasdaq for a change that was the lowest performer today. Looking around the world, international stock indices put in a good Thursday session with the FTSE ripping really higher on the back of that ARM IPO, and other major markets around the world, Germany, China, Japan, and Australia all finished the session higher. There's the VIX falling on its knees again, now below 13. To a super low 12.8, and just taking you out to a weekly chart, that's the lowest close we've had on the VIX since before COVID. And option dealers are not demanding much compensation for the risk of writing premiums at these levels, with the VIX only 1.3 points above realized volatility. So things are really calm in the markets right now. Could still see put call ratios a little elevated with a bit of insurance buying going on, and a nice little pop in short-term breadth here today. 56% of stocks above their 20-day average. However, we've still got those new highs versus new lows deteriorating on the Nasdaq. 68 new lows to 28 new highs today. Over to spread charts, and there's growth sectors versus defensive sectors, kind of just tracking sideways, and growth versus value stocks pulling back a little bit today. And small caps versus large caps trying to find a bottom here after losing the support level and getting a bit technically oversold here. And just taking you out to a clean monthly chart of the spread between the Russell 2000 and the S&P 500. You can see it's now at the lowest levels for over 20 years, going back to 2003. And we could be putting in a big double bottom here. And it's not just technically speaking that small caps are really undervalued to large caps, also on a valuation on things like cash flow. They are very cheap as well. And what I suspect is helped cause this big valuation difference over the last 15 years has been the rise in index funds and passive investing, and a lot of that money has found its way into large caps at the top end, and that's why you see persistently high PEs and valuations in large and especially mega caps. It's not hard to find a good quality small cap with a long track record at a PE of 12-14 these days. So regardless of what the market does over the next couple of years, I think overall at this point in time, small caps do represent good value here as a long-term position in a diversified portfolio. Credit spreads are holding up really well. We can see that in the difference between high-yield bonds and treasuries, still on a nice short-term uptrend. Inflation expectations are still holding up, and there's a look at the 20-year Treasury bond ETF TLT, still trying to find support down these levels here at $93 a unit. And that strong economic data we got today is helping to keep a bid in dollar index futures, sitting just over 105, with Bitcoin looking to continue its bounce off the $25,000 level. And look at that, the march higher in commodities, not even a strong dollar can stop it. In this environment, we gapped up today, held, finished higher on new year-to-date highs, and that's thanks to none other than crude oil, currently holding at $90.53 a barrel, and looks to be in a really strong short-term to medium-term uptrend now. And I think there's a good chance we're going to see $100 a barrel. Who knows, maybe in the upcoming weeks, but I think a good chance before Christmas that's going to happen, and that's going to be hard for the market to ignore that. Uranium ripping higher today on more than triple daily average volume, and just taking you out to a monthly chart. After we had that huge rip in 2021, just like crude, we pulled back and consolidated for most of last year. However, these last couple of months, we are picking up here again in the commodity space. And for those of you who regularly watch my channel, you know I've been a long-term commodity bull. And in fact, 100% of my own personal retirement portfolio is invested in commodity stocks and has been for a while now. And I plan on keeping it that way, likely going well into the 2030s. And a big reason why I'm invested like that is the relative valuation difference between commodities and stocks is showing commodities are currently at some of the cheapest levels they've ever been relative to stocks. And like it says here, over the last 15 years, we've had an everything bubble except commodities. I don't like the current yield in the stock market, and I think commodities has a lot of tailwinds going forward over the next 10 years, namely clean energy policies, which should keep a squeeze on investment and production and supply of traditional fossil fuels, along with an ever-increasing global population, and especially in places like China and India, where more people move from rural areas to metropolitan areas and inevitably use more commodities. And that's why I think I'm going to hold a significant portion of my wealth in commodities for at least another decade, and ideally I'll exit my commodity investment when they get above their average valuation relative to stocks. And for me, it's all about relative yield. Moving on to stock sectors, and we finished the day green across the board. It was only one sector, biotech, that finished the day down. Even defensive sectors like utilities continue to have a really good pop off that low a week and a half ago. And there's the cannabis ETF, which I'm invested in as well, ripping another 6.4% today. And this thing is staying persistently overbought, which tells me there's a lot of momentum and money coming into it. And I want to ride this thing all the way to federal legalization whenever that comes. Got a nice pop in clean energy today, up 2.48%. After we got a bit technically oversold down here. We can see my indicators DSI hidden divergence but forming bullish divergences. Nice little pop in the retail sector today, up 2.34%, and a bit of volume coming into financials as well. Over to popular stocks, and there's BlackRock reclaiming its 50-day VWAP for the first time in a couple of months. Microsoft continuing to drift higher, Google breaking out to fresh year-to-date highs, and NVDA trading pretty flat and soft here. And wouldn't you know it, CEO Jensen Huang is continuing to sell more stock, offloading onto the market at these highs, now clocking up over $80 million in sales just in this month alone. And it's kind of a little strange after their last blowout earnings, apparently beating EPS estimates by 29%. And there's a bit of speculation and rumor getting around on the internet that some of their orders could be fake or, some funny accounting stuff going on. Because like we saw in Oracle and some of the other tech companies, and some people are pointing out is where are all these orders coming from? It's kind of hard to verify all that at the moment. And we got that big rejection candle when the market did open above $500 for the first time after that earnings. And here we are with Jensen Huang selling over $80 million of stock over the last couple of weeks. So this one is key to the market as well, like Apple, as it's been the biggest performing mega cap tech stock this year. And is really at the forefront of why the market is having a good year, and that's on the back of all the hype around AI. So if this thing breaks apart, that's a big break in the positive bullish narrative for the stock market. There's Netflix continuing to trade a little weak after those negative comments from the CFO. And over to the meme space, we had a little bit of a pop-up there as well. There's Carvana, continuing to trade strong, and this has been on quite the rip this year. And coming back from the dead as well as Nikola. On back of more positive news about them producing their hydrogen trucks. Got a nice bounce here today, up 32% on volume. And there's a look at AT&T, having a nice pop here today. And for those of you who watch the channel, you'll remember when it got sold off really hard back here in the middle of July. after that negative news of their lead cables. You remember me pointing out how technically oversold it was and undervalued. According to my stock fair value indicator, we've got fair value somewhere around $29 a share. And even today, that is still 50% below that level. And I don't think it's no coincidence either that dark pool buyers have been heavily accumulating the stock on all of that weakness and have just started pulling back a bit over the last couple of weeks. And similar story in Verizon as well. It was affected by the same negative news on those lead cables. However, it was a bit overblown, as the market often does, and we've still got it as being around 41% undervalued. And there's a look at Deutsche Bank, which is one we had been watching and worried as another bank that could potentially blow up. How it looks to have held on pretty well here. Like some of the other vulnerable regional banks as well, kind of hanging in there and coming back from the dead a little bit. And we continue to see a little bit of a bounce up in the big guys as well. And just looking at my dark pool percentage indicator for the S&P 500, slightly back in the bearish zone today at 43.6%. And the S&P oscillator climbing slightly into the overbought zone as well at 53.6. However, the market's still in a bit of a holding sideways pattern here on low volatility, and we've still got these immediate term support zone and resistance zones slightly above and below the price here. But we did have a good bit of bullish breadth here today. You can see we gapped up and held on this volume, and I would not be surprised to see the market come up and test these highs from mid-July. And I'll be looking to see if price can close above this bearish engulfing pattern. However, like I've been saying, for that to happen, we really need to see Apple hold this support zone here, and other important stocks too, like NVDA and of course Tesla, which seems to be defending this gap up we got on Monday after the Morgan Stanley upgrade and could very well be back at $300 a share anytime now, as the market is probably going to get excited going into the release of the Cybertruck. That's all for today. Thanks for sticking with Click Capital. Appreciate you stopping by. And again, a big thanks to everyone who has taken advantage of my special offer to get lifetime access to my 22 custom indicators for TradingView for the one-time fee of $237. And there's still time for those of you who haven't to take advantage of this offer as well. Just click the link below this video in the description and you can learn more about it there. All right, guys, that's it for now. See you again tomorrow afternoon. Cheers.